Many sights to see, and when I look in my window, so many different people to be, that it's strange, so strange. You got to pick up.
Hello, traders. Gary Wagner here, approximately 10:30 in Honolulu, Hawaii. It is Tuesday, the 19th day of July, and this is the daily report for gold. We have gold in a round of profit taking this morning, currently trading at $1587.50, down about $17 or $18. We are looking at a group of charts, dailies, as well as a 360-minute chart here. But the chart that I want to take a look at and start with is this daily chart up in the right-hand corner. And the reason that I want to really pay some attention to it today, I'm going to go ahead and blow that up, is that in my article for Kitco on Monday, I presented this exact chart that we are looking at. In fact, I'm going to bring that over and show it to you on the screen. This is not a live chart. This is the chart that was on Kitco itself. And as you can see from the chart, let me go ahead and kind of line that up. What I was looking at in this chart, and bear with me, traders, is that my belief was as this market moved up here, what we would probably see is somewhere after 1600, and my target prices were 1614 and 1609. That was the area I felt it would probably retrace a little bit, as you can see in this chart. Now, this is the live chart, of course, that we're looking at right here. So I'll go ahead and I'll move that line so we can see that a little bit better. And as you can see, in fact, we got the market come exactly to that spot. It came right up to that area. Now, in terms of where I think that marketplace itself could go, there are two different areas that I'm looking at. One I charted and presented to Kitco, and that is the 38% retracement area. The other is 23, and I think 23 is just as viable, and I want to go ahead and put that up on the screen now. And what I'm going to do, this is our other daily, and that's the reason that I have it up this morning. Let me go ahead and blow that up. You know that we moved our stop to 1570, and that is because I believe that it's quite possible that the retracement that we're going to see is not going to be as deep as a 38%. I believe that it is more likely that we'll probably get a 23% retracement, which would take us to 1578, of course, above our stop. If, in fact, that is what we see, my recommendation is going to be that this is a tier for us to add to, and for those who were unable to get into the trade at 47, that would be an initial entry point. But we want to be real cautious because there's two particular areas that it has a probability of going to. Now, the 59, of course, would stop us out, and we would just re-enter a new trade here and pull profits from 47. I know that I'm going to get some questions, and the questions are going to be, if in fact you were able to draw that chart, and if in fact you were looking for that market to rally to a certain point and then come down, why didn't we get out at the top? And the simple reason for that is these are projections. I absolutely do not know the future, but I will plot out a likely scenario. I also will always arm you with that information to allow you, the trader, to take that information and do what you feel best with it. So I believe at this point that this particular dip that we're seeing in the market, this round of profit taking, is something that is expected. As I wrote in my article in Kitco on Monday, I said that the bigger they are, the harder they fall, and 1600 is really, really big. The market will probably close above 1600. From there, it'll probably sell off. And that's exactly what we're seeing. My sentiment right now is, and once again, I'm simply looking at the marketplace itself in terms of a retracement level. My personal sense is somewhere around 1580, 1575, somewhere in there, we should get some bottom activity, and that is going to be, as far as I'm concerned, a logical point to tier and scale and add to our position. Also, traders, realize this is my 360-minute chart with our master count, our master Elliott wave count. And as you can see, my belief is that we are in wave 5. Now, take a look at the amount of time that it took for wave 3 to play out. Wave 3 starts, call it the 15th of March, all the way to almost call it near the end of April. So about a 45-day period in time for it to run through that entire wave. You'll notice the same thing is true for wave 4. Wave 1 was from the 28th to the 18th, or excuse me, to the 28th to the 9th, so a little bit under 45 days. This last wave has got a lot of time, I believe, still to work out. So that what I feel is likely and prominent is that what we'll see is something like this. Market obviously hit a top. It's going to come down, and then it's probably going to move up. That is going to be leg 2 and then 3 of wave 5. In other words, this would be the minor count or the sub count found within it. This has been Gary Wagner wishing you, as always, good trading, and we'll talk to you tomorrow for another daily update and review. Bye-bye.
Many sights to see, and when I look in my window, so many different people to be, that it's strange, so strange.